So what I want to talk about is a strategy that I have used in the past uh, to pay off my mortgage. I've also used a home equity line of credit as well for investing. Um, but but the focus today, maybe in the near future, I also want to talk about different types of investing and things you can do with a HELOC as well. But the focus today is just paying off the mortgage early. Um, I know we all have different. We're in different places on this call. I know some people have a home, some people don't. Some people are still paying on their mortgage. Some people maybe not paying on it anymore. But I think it'll be good even if you don't have a home right now. In the future, when you get one, it'll be so beneficial for you to have this knowledge, not only for you but to share it with other people, which is what I'm doing. I'm actually debt free right now, and I love it. I love it. Um, and one of the ways I was able to do that was with using the HELOC. One of the ways I was able to grow what I have is with the HELOC. So, so what we're going to talk about is the traditional way to butt a home mortgage. I got to fix that, to buy a home mortgage. And we're going to talk about what a home equity line of credit is, and we'll look at some real world examples of using a HELOC. Then we'll also look at how you can qualify for a HELOC. And by the way, a HELOC, we're going to look at the definition later, but it stands for Home Equity Line of Credit. So I say HELOC for short. And then we'll also look at some consequences of using it incorrectly. So it can actually harm you a great deal if you're not responsible in the way that you use it. If you're not disciplined with your money, um, it actually can cause you to get into more debt instead of what we're trying to do, which is get out of debt. So just checking to see who's with us. Shalom, everyone that's joined us. Um, so, so this the first thing I want to say, this is for financially disciplined people only. There's some people in my life that I know are not financially disciplined, and so I would not recommend this strategy at all, because it's going to give you access to more money, which everyone loves. But if you have a problem with spending money and not using it for the right purposes, then it'll actually just put you more in the hole. So that's just my caveat about this. Is really for financially disciplined people. Also, before I go on, please stop me at any time. You don't. I may or may not see your hand because I'm presenting. So if you just want to come off the mic, please do that. Don't feel like you're uh, being rude or anything, because I know when I first learned about this, I had a lot of questions. I had a whole lot of questions. So if this is your first time looking at this strategy, or you have some questions, please just let me know. Okay. So for the first step, when we want to buy a home, what we do is we go and we pre-qualify for a mortgage. Traditionally, that's what we do. So we got Joe here, and so what he's going to do is he's going to get a pre-approval letter from a credit union. And let's say he's gets a pre-approval for about $325. Usually, you can go to a bank, you can go to a credit union, or some mortgage lending institution. So the next, of course, we all know this. Uh, we look for the home, And let's say you find a home for about $300,000. So the house is everything you want. So you decide we're going to buy this home. Then next, now this is what the majority of people do. I would say maybe somewhere between 95 to 99% of people, at least in America, what they're going to do next is get a mortgage. So the home is $300,000. So now they're going to have a $300,000 loan. Um, what most people don't realize, they know it, but it doesn't really hit home until you actually look at the numbers about how much debt comes with this $300,000. It's not just $300,000. We know there's interest, but it's actually a lot more than we actually think about or contemplate. And so I'm going to show you that, and we're going to look at how much money we pay if you get this traditional 30-year mortgage. So after you decide, okay, I'm gonna get this home, the bank is gonna let you know we can give you this mortgage at a certain interest rate, and the rates aren't this low now. This is the rates that it used to be, um, months ago, maybe years last year, the rates, but the rates have gone up significantly over the past year or so. They've gone really high. But I'm going to show you two different examples of how much interest you actually pay when you have a mortgage. So 4%, this is what closer to what most people now that own homes have. That as long as you have decent credit, your interest rate is probably going to be somewhere around 3, 4, 5%, something like that. So 30 years, and your monthly payment is going to be 1432. That's not including taxes and insurance. So I'm gonna factor all that in later when we do some of our calculations. But this is just the interest and the principal payment. So what this ends up being, uh-oh, I didn't know I had some animations. Okay, what this ends up being over the course of 30 years, if you pay on that mortgage, it's not $300,000, it's $515,000. So what you're told when you go to the bank or when you go to get a mortgage is that your interest rate is going to be 4%. Um, but if you look at the total amount paid of interest over the course of 30 years at a 4% interest rate, you are you're paying over $200,000 more than what the house was listed for. So I like this number 71%. I like to look for this number when I get a mortgage, because this number is you can always see what the total interest is for a particular mortgage, and it's usually pretty high. I remember looking in the past at one of my homes that I had, and I think the number I saw was around 69% or 70%, somewhere around there. And some are 90%, some are even higher than that. And that's really the true amount of interest you're paying. This 3%, 4%, 5% interest, uh it's really deceptive. It's true in the way that they use it, but over the course of 30 years, it's not really true. So this is the American dream. This is what we all want. We want a home, right? We want a house, but it comes with so much more. Now I want to look at another example. This is based on today's interest rates. So I'm still using a $300,000 home, but now if you go to the bank You try to get a mortgage, it's going to be somewhere around 7.5%. So almost double. So the monthly payment has kind of jumped up quite a bit, almost $600 to $700 more. And so when you're done with this mortgage, 30 years from now, that $300,000 has turned into $755,280. And just in case somebody doesn't believe me, I got my trusty little calculator here, and we're going to put this in 2098. I multiply that by 360. 30 is 30 years, but your monthly payment is there's 12 months in a year. So that would be 30 times 12, which is 360. 360 months, $755,280. Now, that's kind of ridiculous. um, that's that was really eye-opening for me when I did this calculation because I didn't realize it was going to be jump up that much from 4% being 515 to now $755,000. Let me ask a question. Is anybody right now looking for a home or about to buy one, or that's on their mind? In anybody, you can. Okay, I see John. He's thinking about buying one. Anybody else? Anybody want to? Maybe they're not doing it right now, but you want to. Okay. Well, just to show you, this is kind of this is what you're going to be paying. Okay. Uh, Agdawi saying he wants to buy one, so this is what it's at right now. That's really high. So because of all of this, I said I gotta help out the people of Yah. This is a We can't be paying this. This ain't no American dream no more. This is a straight up nightmare. Straight up nightmare. Um, so what we're gonna do is let's look at the definition of a home equity line of credit, and we're gonna look at some examples of how we can use this home equity line of credit to avoid paying all this interest. Over 400 some $1,000 of interest. So a home equity line of credit, or Heloc for short, is a second mortgage that gives you access to cash based on the value of your home. It can also be a primary mortgage. So there's some people that uh, get a Heloc as their first position loan and don't even have a traditional mortgage at all. But what I'm focusing on today is the second position, which is where you use a home equity line of credit as a second mortgage. That's the focus for today. So you borrow against your equity, which is the home's value minus the amount you owe on the primary mortgage. So uh, there's different lenders, there's different credit unions and banks. They give out uh, different different amounts of money to you based on your equity, or credit, I should say, based on the equity in your home. So some you'll see will give you 85%. They'll give you 85% of the equity within your home. Others will give up to 100% or even more. I've seen some institutions give over 100% of the value of your home. So what the equity is, just to make it simple, is the market value of your home So this home right here is $300,000. The amount owed uh, on your loan, let's just say, for example, someone's owned this $300,000 house. It's worth $300,000 house, and there's $240,000 left to pay on the loan. When you subtract this from the value, then that gives you your equity, $60,000. So a bank or a credit union, I tend to use credit unions. I don't use banks at all unless I absolutely have to. Like for example, I have a mortgage right now that is with a bank, but that there's nothing I can do about that. So, but other than that, I find it to be more favorable to use credit unions. Um, but anyway, so $60,000 is the equity that this person would be able to get from the bank if he finds a lending institution that is willing to give him 100%. So, just to give you a quick example, I just moved from Washington, and I know there's several people that live in Washington that are on the call. Uh, when I was in Washington, I used a credit union called ACU, America's Credit Union. And I only use this bank strictly because of their home equity line of credit. Um, so at the time that I got the home equity line of credit, the borrowing limit that they gave was 100%. So now it looks like they have maybe decreased it because now it's 90%. But that's pretty good. That's pretty good. So if they were giving 100% the borrowing limit, then that means that in this scenario you would get $60,000 line of credit. Okay, let me stop. Is there any questions yet? Any any thoughts before I keep going? No questions.
I do have a question.
Okay.
So you get 60,000 equity, but that's still money you got to pay back.
Yes, if you use that money, so they'll give you a line of credit, just like a credit card, right? So when you have a credit card, you can use it for whatever you want, and it'll just be there sitting until you spend it. And yes, so once you spend it, just like with a credit card, you have to pay it back. Now, as we're going to see later, the difference though between a home equity line of credit and a credit card is that a home equity line of credit, the interest is way less than a credit card. And the reason that it's much less than a credit card is because it's secured. The line of credit is secured by your home. The bank knows if you stop paying on this line of credit, you're that they can take your home. It's the same thing with your mortgage. If you stop paying your mortgage, they will foreclose on your home. So, um, but because it's secured by a home, the interest rate is much lower. Does that answer your question?
Yeah, it makes me think then there could be a positive to this equity if you use it right.
Hmm. One other thing I want to point out too. This home, the equity is $60,000. The market value of the home is not based on what you paid for it. The market value is based on what it is worth within the market. So that means if you were to put your home for sale, if you paid, say, $200,000 for it 5 years ago, but now it's worth $300,000 if you put it on the market, then that is the market value. So I had a similar thing happen to me when I on the second home equity line of credit that I got. Uh, my home, I had a home that I paid, I think it was around 275. So that home went up in value quite a bit. And so by the time I was ready to get a home equity line of credit, they were willing to give me over $250,000. And I hadn't even paid more than $20,000 into the home. So my point is, this market value has nothing to do with how much you've paid. It's more to do with what is the home worth. Then you subtract that from the amount of the loan. So just to let you know that. So now what I want to do next is we're going to look at an example of a traditional mortgage and the amount of money that you pay when you have a traditional mortgage. And then we're going to look at an example of applying the Heloc, using the strategy of using the Heloc to pay down your mortgage. So please stop me if you have any questions. Um, so this we're going to look at the example we were just looking at. So a 30-year mortgage, uh, and we're going to assume that we're not making any additional payments. So when you have a mortgage and you make your monthly payments, you have the option to just paying the minimum monthly payment, or you can choose to make additional principal payments. So we're just assuming that we're not making any additional payments. Whatever that monthly fee is, that's what we're paying. So in our example that we were looking at earlier, uh, this example, the $300,000 house, it ends up being $755,000 over the course of 30 years. Um, the total amount of interest paid over the course of 30 years would be $455,000. So you've paid for a house and a half just in interest alone. Um, and this is over 360 months.
Wait, I got a
So
question again.
go ahead.
Back to that.
Yep.
So you're buying a house for 300,000, but your interest payments is 150,000 more than what you're paying for the house. Is that what you're saying?
In this case, uh, yes.
So
These
you
these are
haven't
the.
even paid
I'm
for the
sorry.
house yet. You're just paying. You're paying for another house. It's in the form of interest. That's what you're saying.
If over the course of 30 years you don't make additional principal payments,
Hmm.
yes.
Wow, that's crazy.
Now, this is for people that want to buy a home today. The
Jeez.
people that already have a home, their interest rate is going to be smaller than this, but you're still going to pay a lot of interest. A lot. So the example that we use, this is more typical of what most people have today. You're still paying over $200,000 in interest. So it's just worse now than it was a few years ago. So what we're going to do now is we're going to look at each how much money goes towards paying down your house each monthly payment that you make. So this first row here, I know it's a lot of numbers here, but follow me. You first you have a monthly payment of 2097 dollars. On your first payment, only $222 will be applied towards the principal. Let me make sure this If anyone doesn't know what I mean when I say the principal, please let me know. So $222 is applied towards the principal. $1,875 is applied towards interest on your first payment of $2,097. If you never saw that before, that should be shocking to you. But that's what most people are doing each and every day. It seems a little lopsided. Actually, it's a lot lopsided. 1,800 versus $222. So this is why, it's going to take 30 years to pay off this home, because so little is actually being applied towards the principal. So this is assuming if you don't put any extra payment per month, it's this is what it's going to be. So at the end of your first month, the remaining balance is still going to be $299,777 because only $200. Now the next month, the second month, it's the same thing. $224 going towards the principal. So you have to wait 5 months before $1,000 goes towards the principal. 5 months. Now, over this past 5 months, though, you've paid over $10,000. You've paid $10,000 with just a basic traditional mortgage. You paid $10,000, yet only 1,000 is going towards principal. Go ahead. Whoever has a question.
It's me. Shalom, Mishpacha.
Shalom.
Uh, I came a little late, so I don't know if you already covered this, but so are you saying that the HELOC, does it replace the traditional mortgage loan that you have, or how does it tie in and make and becomes beneficial to you so you're not paying all that interest? Like I said, I came late, so you might have already covered that.
So we briefly covered it. I'm not done covering it though. So I can briefly tell you this. There's If I go back to the slide, there are two different ways that you can get a home equity line of credit that I'm aware of. One is you can get the home equity line of credit as a second mortgage, or you can get it as a primary mortgage. I'm right now only referring to using it as a second mortgage. So the home equity line of credit would once you are eligible to get it, you apply for it, they give you access to the home equity line of credit, then you would use that money towards paying down your mortgage. But I haven't broken down yet how we use it or any of that yet. That's going to be in the next slides after I'm done showing this right here. But good questions. So I hope everyone's seeing this. $1,000 after 5 months is being applied towards the principal. So after 5 months, let's look and see what is our remaining balance. Our remaining balance is $298,000 from $300,000. So $298,000. So yet we've already paid for a car at $10,000. So this is why we need to know this strategy. I was looking at this earlier with my wife, and I was saying, man, every 6 months I can buy me a decent car. If I'm just paying mortgage and I'm not using this HELOC strategy, I'm just giving the bank a car every 6 months. So, all right, let's This is the way it goes. So if we look at this, uh 360 payments, once we get to the bottom, you'll notice here that once you get towards the end of the loan, you're paying more towards the principal and less towards the interest. So at the beginning of the loan, you're not paying hardly anything towards the principal, just $200, and a lot more towards the interest. So the banks, they're clever. They 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 figured out a way to get the most interest out of us up front. So even if you want to try to pay down your mortgage, they're going to get their money first. That's because the loans are amortized. So when you talk to a bank or you go and you try to buy your home, you know, many times they're not going to show you this. They don't want you to know about this, because if you see this, you're going to be in shock and you'll be like, let me think twice about whether or not we should get this home. So hopefully this is making sense so far. Now I'm going to show you an example of what happens when you use a Heloc. And so now let's look at the 30-year mortgage again. And with this 30-year mortgage, we're now going to include our bills. We're going to include the income per month that we make, and we're also going to include how much money is left over. So this is kind of like our budget. We're paying. We got this $2,097 payment that we have to make every month, but we also have other bills we got to pay for. We got to pay for utilities and whatnot, food and whatever. And in this example, I'm using someone that just makes 6,000. If you make more, even better. But I'm using $6,000 because I want everyone to see that, even if you're making a smaller amount of money, not that this is a smaller amount of money, I'm just saying, if you're making, you don't have to be making like six figures, for this to work. You could be making somewhere in the mid, you know 50, 60, and still save a lot of money. Save a lot of money. So in this example, this guy, he's got $900 left over after every month, after all his expenses are paid. And we're going to look now at this same schedule, only this time we're going to use the home equity line of credit. We're going to use the money that we receive from our home equity line of credit to make payments toward our mortgage. And just to remind you, the home equity line of credit, we haven't gotten here. The home equity line of credit, it's like a credit card. So the bank is allowing you to borrow money in terms of credit. So when you take money and you use it, say you take, like in this example, we're using $10,000. Say you take $10,000 from that account. You we're going to take $10,000 from our line of credit, and we're going to pay our mortgage with it and any bills we have, and whatever is left over, we're going to add this payment to the principal. Does that make sense? Uh, Let me know if I'm making sense or if I need to slow down. Okay.
Can you just repeat that one more time?
Okay. Okay. So the home equity line of credit is like a credit card that the bank is giving you based on the equity in your own home. So instead of you borrowing from the bank, it's really like you're borrowing from yourself. I'm the bank now because this is money that I have invested into my home. So you can think of it like a credit card that the bank is going to give you or the credit union is going to give you. So now with this credit card and the strategy that I'm about to show you, before I show you all the numbers, I just want you to understand that we're taking money from our home equity line of credit, and then we're going to use that money to pay off our mortgage, our monthly payment, our bills, and make additional principal payments. Because really that's the key to all of this. The key to paying down your mortgage early is the additional principal payments. The home equity line of credit is just going to allow you to make additional payments though, and have some it'll allow you to be able to pay your home off faster, and it'll give you a cushion. It'll give you a cushion. So if you need money for some reason, you have that money in your line of credit, which I'll get to later. But does that make sense? Uh,
Yeah, yeah, it
okay.
does.
All right. All right. Now I'm gonna go back to our spreadsheet. So here on the spreadsheet, we still have the amortization schedule. This is a 360 months of making payments. The difference is now we're going to add a $5,000 payment approximately every 5 to 6 months. And what I want you to realize is that the income of this guy, his name is Joe. The income of Joe is not going to change. He's not making any more money, nothing less. We're assuming that Joe's income is going to be the same for the next 30 years. And even with his income being the same for the next 30 years, he's still going to be able to pay off his house in record time. And he's going to literally save hundreds of thousands of dollars if he buys this house. So, all right, I want to remind you, this first one, this was no extra payments. After 5 months, we only paid down, let me see, 5 payments, we only paid down $1,127, and $298,872 are left. And the amount of interest that we've paid after 5 months is $9,361. That's the accumulated interest. So the accumulated interest is basically all the interest summed up together. So after the first month, it's 1875 that you paid in interest. After the second month, it's 1873 plus 1875. So this is just totaling up all the interest you've paid up to this point. So once you get to the fifth point, we've paid $9,361 in interest, yet we've only gone down about $1,100 in the principal. So now let's apply the HELOC. Oh, go ahead if someone raise their hand. You might be on mute if you're talking.
Oh, sorry. So I'm just thinking of a scenario in my head. If I live in a house, it's not paid for, and I get this, let's say I get an inheritance of a nice, couple like $20,000. Is it smarter for me to put that 20 grand towards paying my house off, or should I take it and improve upon my house, therefore increasing its value, and I'm thinking therefore increase the equity in the home?
Let Do me a favor.
Yes,
Table that and let's come back to that after we're done because
gotcha.
I want you to answer that question after you see
Oh,
all the
okay,
stuff I'm going to show you.
okay.
Okay. So, um, this first month, we're going to put an extra $5,000 toward this principal. And let me add this here just so we're clear. Extra payment principal. This is an extra principal payment, $5,000. Now, you might be asking, well, where did this money come from? Like, where am I just going to get an extra $5,000 from? Well, you're getting it from the equity in your home. This is, you're not like pulling it out of savings. You're not having to ask somebody if I can borrow it. This is money that you already have in your home. Go ahead. As someone raise their hand, you're on mute.
So you're saying that as soon as you buy the house, you can get the equity?
Well, some institutions, what I've found, may have a certain amount of time you may have to wait. Like you might have to wait like 6 months, or it just depends. I think on the bank. Um,
Wow.
so it could be that you might have to start this on month 6. Um, but I think that depends. It depends on what their rules are at that institution. But just for the sake of demonstration purposes, I'm just starting it off in the first month, just so it's easier for us to understand. So $5,000, right? And this is money that we have now as a line of credit. And let's look now and see how much money is being applied uh, after we put this $5,000 towards the principal. And this in this example, 294 $294,000 is what we're at once we apply an extra $5,000. 294,000 with no additional payments. Let's look and see how far we got to go down till we get to 294,000. Wow. So we have to go down to the 22nd month. That's 22 months worth of payments of $2,097 before we get to the point where our remaining balance is 294 or $294,766. So do you know the amount of interest you will have paid in 22 months, which is almost 2 years, is $40,000. $40,000 in less than 2 years is the amount of money that you will pay in interest with this, um, without making any additional principals. So I'm going to get to the hand just a second. So what I would ask, is it worth me putting an extra $5,000 so that I can avoid paying $40,000? To me, it's a no-brainer. Go ahead, Caleb.
Okay, so the reason why the money that you're taking from a HELOC loan on your mortgage doesn't go towards the interest is because it's straight equity out of your house versus you paying cash and that going towards the interest. I'm just trying to figure out why does the money from the HELOC loan bypass the interest versus
Okay. Yes. So that's going to be right after this. Right
okay.
after this, I have the slide that's going to explain how much interest are we going to pay, Because yeah, you're right. At this point, we have a mortgage and a line of credit. So I know what most people are thinking, people that have never heard the strategy. You're thinking like, well, why, as nice as this sounds, why would I want to have two loans? Like, this doesn't make any sense. Like, but it's gonna all make sense when we're done. But I you got to see this part first, though. Once you see this part, it's going to help you understand why we want to use this strategy. So this $5,000, this one $5,000 payment is going to it's going to be the equivalent of removing 21 payments. And that 21 payments is $40,000 worth of interest. Or maybe you'd say 39,000 if we're going to be technical. $40,000 wiped away when you make one extra payment of $5,000. And so this is why if you keep using this strategy, the strategy that I'm about to show you of making extra principal payments every 5 to 6 months, or for some people it might be every 10 months. Some people it might be every year, or some people they can do it every month or every other month. It depends on your situation. It depends on how much money you make and how much you're comfortable with doing, or whatever situation in life you're at, will determine that. Also, how much money the bank allows you to qualify for when you apply for a home equity line of credit. All of those factor into how much extra principal payments you can make. But the beauty of all of this is this guy, Joe, he makes $6,000 a month, and his income does not have to change for him to make these extra principal payments of $5,000 a month. So now I'm just going to show you an example. If we keep doing this, this loan will be paid off within 155 months as opposed to 360 months. So 155 months is approximately 12.9 years. So less than half of the time, 12 years approximately to pay this thing off. And if you look at the amount of interest that you will have paid, it's $167,767 as opposed to your 30-year mortgage still going $455,000, $155. So that extra payment, not only does it reduce the amount of time significantly, you're also paying a whole lot less. 167 as opposed to 455,000. I don't even have to do the math. Y'all can see the benefit of that. Okay, now let me stop, make sure, is there any questions? Okay. One more thing I want to point out. So if you were to use this method, just this one example, we can use all kinds of examples. I can put any number we want to put in here. I could put a higher price house, a lower price house. I could change the salary that someone makes to make it higher or lower. We can change the interest rate to make it fit your specific need. And then you can see how much money, you're having to pay for this. With both strategies, using the traditional way or using the Heloc. But just with using this extra $5,000 every 6 months strategy, if you do that, you'll save $287,000, $287,000 by doing this strategy. So all the next slides that we're going to see, keep that in mind. Everything we're doing is so we can save this amount of money. And this is the minimum amount that you'll save. Because if you decide I want to put more than $5,000, you can do that. And that just means you'll save even more interest and do it in less time. So let's go to the rest of the slides. So now in this example, we're going to go through the process of how do you use the HELOC, and we're going to, since it's 6 months, it takes 6 months. Let me show you this one more time. So it takes 6 months before we can apply $5,000 again. So we're going to see how this all works. So let's imagine we're at month 1. We're in month 1 right now, right? It's the first of the month. It's the first month of the new pagan year. Let's say when we get, let's say, what's today's date? Today's date is the 18th. So let's say we just went to the bank and we applied for a HELOC, and they gave us a $20,000 home equity line of credit limit. So that means this house that we just we paid for, it has enough equity that they decided to allow us to get $20,000. You know, this example says $60,000, but I'm just showing you as an example. We have enough equity that we can get at least $20,000. And just because a bank is willing to give you say a bank is willing to give you more money, you don't have to take it. You can take whatever amount that you want, as long as it's what they've approved you for. So $20,000. So now it's the last day of the month, or at least toward the end of the month, and now all the bills are due. And just to remind you, our house payment's $2,000. The rest of our bills is $3,000. And by the way, for those of you, I'm sure you notice, in this $2,000, we're not really including the insurance and the taxes, but I'm including all that with all these additional bills, because the examples we've used so far have just been principal and interest. But you do have to pay taxes and insurance, and sometimes, yeah, that's basically it, taxes and insurance. And the income is still $6,000. And this guy, once he's done paying his bills normally, he has $1,000 left over. Okay. So bills are due on the 18th. Today we applied for our HELOC, but on the 30th we know all the bills are going to be due. So what do? We take $5,000 out of our HELOC that we were just approved for, and we pay our bills, because our bills is this $2,000 plus $3,000. So that comes to $5,000. But in addition to that, we also take an additional $5,000. That's where our extra principal payment is coming from. So now, that means we're taking $10,000 from this account, this home equity line of credit, which is essentially like a credit card. And now all of our bills are paid for, and we have some extra going towards this principal payment, so we can take advantage of these savings and cut out $40,000 worth of interest. That's the goal right here. We want to get to here, so that's why we're taking out an additional $5,000. So after you do that, then that means on your home equity line of credit, you still got $10,000 left. But we're not going to spend this money. We're just going to let it sit. Now, it's up to you how you want to use this, but I'm just giving you my example of how I used it and how it helped me. So there's a couple of reasons why I like to not use all of the credit. For one, when you max your credit out, your credit score goes down. So I like to not use all of it if I don't have to. So that's one reason. And the second reason is, as we're going to see in the next slide, um, you're going to need some extra buffer room. This $10,000 gives you some extra, a cushion, if you will, some extra savings. In case there's like an emergency or something, you'll have some extra money to use. So I hope this part is making sense so far. Please stop me if it's not. So you have 3 steps here. You have your account that gets created. You take $10,000 out of that account. You pay your bills, your extra principal payment, and then now all your bills are paid for, and you have $10,000 left on the balance of this account. Okay, now next slide is month 2 now, and it's day 1 of month 2. So we're at the beginning of the month, and it's payday. I love the first of the month. I love it. And the first, I get paid. So in this strategy, he makes $6,000. Joe's making $6,000 a month. So that means he's going to make $3,000 for this check. So if he gets paid bi-monthly 2 times a month, then that means $3,000 on one check and then $3,000 on the next check. So what we do is we put $3,000 into our home equity line of credit. We take our entire check, we deposit it into the home equity line of credit. It's kind of like paying off your credit card. Once you've done that, now the balance on this credit card now is going to be, you only owe $7,000 because you just put $3,000 toward it. And now you've got $13,000 now remaining credit that you can use on this card. So next, on day 15, we get paid again. So it's another $3,000. We take this $3,000 and we deposit it into our Heloc account. The Heloc account works like a checking account. So when I had my Heloc before I moved here to Texas, they gave me a card that's like a debit card. They gave me checks, and I had pretty much all the same features that I had on my checking account. So you can even have a check, your paycheck, deposited into your home equity line of credit. And so that way, as soon as you get a check, you're paying down this home equity line of credit to get the balance as close to a zero as soon as possible. So on your second check, you get that, then that's going to reduce the balance to $4,000. And now you got $16K of credit remaining on this credit card. Now, to get to Caleb's question earlier, so you were asking me, how do you avoid paying interest on this HELOC? There is a way to avoid paying interest where you actually don't have to pay any interest on this strategy at all on your HELOC. I'm not talking about that today. It's a little bit more advanced. If y'all are interested, I'll do another one of these and we'll talk about that, on how you can actually make this essentially zero. It may not always be zero, but it'll be pretty close to zero. So let's look at a bank. Let's look at a real life example to see what the interest rates are. So this is the bank that I was, or the credit union that I was using for a home equity line of credit. Today, their APR, if you're owner occupied, that means you live in the home, it's going to be anywhere from 7.5% to 9.5%. That is the same interest rate just about for mortgages right now. So the difference, though, between a home equity line of credit and this traditional mortgage that we've been looking at, the mortgage is amortized. I'm not so sure if I'm saying that right. Amortized, I think. Whereas a credit card or a line of credit is simple interest. So because a mortgage is amortized or amortized, however you say that, remember I showed you earlier, you pay more interest at the beginning of the loan because of this amortization. This is the way the banks are making so much money off of us. That's why we can pay $300,000 for a home, or it's listed for 300, but we end up paying 755,000 for it because of all of this interest that's paid up front. Well, with a line of credit, it's simple interest. So you don't end up paying as much interest with a home equity line of credit as you do with a traditional mortgage. Also, I'm going to break out the calculator so we can look and see what 7.5% would be in this example. So if we go back to our first slide, we have a balance of $10,000. So the interest we're going to pay is going to be based on this $10,000. And the term can be, I don't know if they have it on here. It can be 10 years or it can be 20 years, 15 years. I've even seen some 30-year home equity lines of credit. But typically you'll see you'll have 10 years, 15, 20 years, something like that. So if we look at the interest rate, the amount of interest that you'll pay with a home equity line of credit, we say $10,000 times 0.075. That's 7.5%. That's $750, and we divide this by 12. That gives us $62.50 per month of interest. Now, this is getting a little bit into the details, but it's important. It's very important. Home equity line of credits accrue interest daily, whereas your traditional mortgage interest is accrued monthly. So actually, $10,000, if we want to be very specific on how much money you're going to pay, you would say $10,000 times 0.075, and then you would divide this by 365. That means you're paying $2 a day to use this $10,000 line of credit, as long as the balance is $10,000. So if you have a balance of $10,000, let's say for a month, you're not going to have it for a month, but let's say you did have it for a month. that would be equal to 2 times 30 days. Um, I'm sorry, that's just $60. Let me just write that here. $60 per month. Make that so you can see it. Interest. So you're paying $60 per month of additional interest, assuming you have this balance this high. So let me ask you a question. Is it worth it for you to pay $60 a month of interest to take away, what is this, 22? To take away $40,000 worth of accumulated interest on your mortgage, or have the equivalent of taking away 21 payments. That's essentially what you're doing. Because this is not a large amount of money, $10,000, the interest is small. And it's simple interest. It's not amortized interest. And this is why most of you haven't heard about a HELOC until recently. Many of you, because the banks don't want you to know about this. I have gone to many banks and had to explain to the bank representative for like 10 minutes why I'm getting a HELOC and why I'm doing what I'm doing. Like, I don't know how many people I had to do that to. But this is the main reason. I'm paying $60 a month to get rid of $40,000 worth of interest. Go ahead. Uh, Whoever raise your hand.
Yeah, it's me. So you're saying when you went to the bank, they didn't even know, or
No.
they didn't want you to do it?
Well, they know about their product. They know about the home equity line of credit. Let me see. There's somebody on here, or somebody that was supposed to come that actually works for a bank. He told me he might not be able to come but yeah, he's not on here. He deals with home equity line of credits. He would give people home equity line of credits, approve them, and all that kind of stuff. But he didn't understand why I would take out a home equity line of credit to pay towards my mortgage until you do the math and you realize that the home equity line of credit is simple interest and a mortgage is amortized. And so the amount of interest you're paying is so small that it's worth it. It's worth it. In addition to that, if you're just using your check and putting it towards the home equity line of credit every month, uh, you're not having to increase your income. It's just taking care of itself. Go ahead, Caleb.
Yeah, I think you misunderstood what my question was. My question was basically, how is it that the HELOC loan put towards your mortgage bypass the interest in your mortgage versus you coming out of your pocket and paying the mortgage and having to pay all that interest? Like what makes it that that loan in particular allows you to just pay towards the principal directly? That's really what my question.
So what's the difference between making the home equity line of credit with a HELOC versus just using your paycheck to add additional income or additional principal payments? Is that what you're saying?
Well, I understand what it's doing, but I'm saying, why is it that the HELOC going towards your mortgage just hits the principal and not having to pay all that interest versus
Oh, I
when
see
you're,
what you're saying. I see what you're
yeah,
saying.
what makes it so special that it just
It,
bypasses the interest and goes towards the principal?
no, no, no. You have to tell the bank, I want to put this towards my principal. So if you for example with my bank, I sometimes I pay online, sometimes I pay over the phone. If I pay online, there is a box that says additional principal payments. And so that is where I would take the money from my HELOC and I would pay the additional principal payments out of my HELOC account. Well, actually, I'd pay everything out of my HELOC account. I would pay the monthly payment and the additional principal payments. When I call in on the phone, they also give me the option. They say, what do you want this payment to be applied to? Do you want this to be applied to your monthly payment? Do you want this to be an additional payment towards the principal? And they have one more option they ask me. So you have to specify. You have to tell them. If you don't tell them, then most likely they're just going to put it towards your monthly payment, and it's going to be applied to uh yeah, just your monthly payment. So it's going to be going. Most of it's going to be going towards all that interest, and that's what you
So
don't want. Yeah.
so so if I wanted to pay just regularly towards my principal without
Yes.
using a HELOC, a person could do that, right?
Oh,
Or
you can. You can do that. The what sets this apart though from just making additional principal payments in my mind is that if you say, let's use this guy Joe for an example. Say he pays his bills $2,000, $3,000. So now he's paid $5,000 towards his bills. He has $1,000 left over, but he wants to put a $5,000 every 6 months like we're doing. Well, he's not going to be able to do that because he only has $1,000. So that's okay though. You can do that. Just put $1,000 every month. That's fine. But now at the end of the month, he has no money left over. He's broke. Whereas if you're using a HELOC, you have, in this example, you have an extra $10,000 to use if you need it. If there's an emergency or something, Joe pretty much he's out of luck. It's nothing he can do because he spent all his extra money. He's gonna have to dip into his, savings. But this affords you the ability to be a little bit more comfortable. Also, it allows you to put more money up front uh, towards your mortgage. So to give you an example, when we were looking at this first payment, with this first payment, we were able to make a $5,000 extra principal payment from the jump. If we did not have the HELOC and Joe does not have money in the bank, enough money in
okay,
the bank, then he's going to have to just do 1,000, 1,000, 1,000, 1,000, 1,000. And then when he gets to this month, uh, you know, it's it won't have the same effect
it
because
makes it makes sense because the HELOC just gives you that wad of money up front that you
yes,
can just whop on your mortgage versus you have to work for it. Okay, okay,
yeah,
that makes
yeah.
that makes sense. Okay,
Now that's a good question. That's the same question I had. So I'm almost done. I'm just gonna go through this real quickly and then we'll be done. I don't want to take much time. I know it's getting late. So this is this bills due. You keep doing this cycle. Your next payday, you get paid $3,000. That goes into the HELOC. Then that reduces your balance. Then the next payday in the middle of the month, same thing. Now your HELOC is the balance is reduced to $4,000. And now you're at the end of the month, your bills are due again. So now we have to um, pay our bills $5,000 from the Heloc, and now our balance has shot back up to 9,000. So the Heloc balance is going to go up and down, but it's going to trend going down. So after you do this, once we get to about the end of the 6th month, now our balance is 0, and we can start the process all over again. So once we get to the middle of the 6th month, our balance is 0, and we can start making additional payments immediately. And that's how this let me go back here. That's how we can do this, make these payments every 6 months, 5 to 6 months. Any more questions before I go to my last slide? I know that was a lot, kind of quick, but I want to make sure.
Yeah, just one more last question. So you have to pay like a credit card what it is that you take out of that HELOC. So Joe took out 10,000. He has to pay that back by the end of the month, right? Like a credit card, right?
So yes, so if you take out $10,000, you don't have to pay all the $10,000 in 1 month. You have to pay whatever the minimum payment is. So the minimum payment with this bank that I have up right now, or credit union, is 1% of the outstanding balance. So that's the minimum you have to pay. Now, you don't want to pay the minimum. You want to put your whole check towards it, or at least as much as your check of it as you can, because that's going to allow you to pay it down much more faster.
Right.
And you're not going to be hurting for money, because you still
You
have,
got your bills paid.
yeah, your bills are paid, and you got the rest of that Heloc to
Right.
use if you need it. So 1% in this example, when you're at $10,000, what is that? a hundred bucks.
$100. Yeah.
So you have to pay at least $100 a month.
Just
Now,
like the credit card minimum payment. You can pay that
yes,
little bit, or you can pay it all off and not have any interest for that amount you owe for that month.
that's right. That's right. So you are going to have some interest, but as I told you, it's very low, uh, very low, and you're not going to feel it. You're not going to feel that interest, because uh, your entire check is going towards the Heloc. And at the end of the day, um, you know, you'll have this thing paid off. Now, you can use, if you're really aggressive with the strategy, there's no reason you can't have your house paid off in 5 to 7 years. I'm using this example, but you could be more aggressive than this, and you could get it done uh, twice as fast. So instead of that 12 and a half, 13 years, it'd be more like 6, 7 years.
Hey, Joel,
Yes.
this is Risha. Are there any benefits to this? If you already know you don't want to stay in your home for the whole 30-year loan,
Yeah.
just know
Yeah.
you want to sell it. Oh, okay. Can you explain that?
Yes. So the quicker, or I should say, the more money you put towards your principal, the less interest you're going to be paying. So I did not do the calculation. I should have did that. I should have pre-did it before I did this meeting. But I had a house. I don't remember which house it was, but one of those maybe it's the last house that I sold. I knew my plan was only to be there for 3 years, but I knew that if I start paying down the principal immediately, I would have some savings because you're going to be paying less interest. So, for example, in this first example that we're looking at right here, if you make a $5,000 payment, uh, that the next month, your interest is going to be 1842 as opposed to 1870. It's over here, as opposed to 1873. So I'm sorry, 1842. So your interest payment dropped by, what is that, $33? $33 because you decided to put this extra $5,000. The next month you're going to save $33 for that month. And if you add that up over time, depending on how many years you're in the house, it just keeps adding up. So you may not save like hundreds of thousands of dollars. If you're only in your house for like 5 years, you're not going to save that much, but you're still going to save. And then when it's time for you to sell your home, you'll also have paid down more of the principal. So when you go to sell your home, you'll be able to get more money out of it. So right now, if you're only paying the minimum amount that the bank asks for you to pay, let's look at this example. If you're just paying the minimum amount every month, you could be paying for your home, let's say for 3 years. We go to the 36th month. This is a $300,000 home. By the time you get to the end of the 3rd year, you have only paid down $9,000 towards the principal. $9,000, yet the total amount of money paid, the total amount is $75,000. So in 3 years, which with no extra payments, you will have paid $75,000 towards your home, but on paper, it only looks like you paid down about $9,000. So you'll get more money back, and you'll pay slightly less interest. You'll pay less. It's not going to be the huge savings that you'll see, but it'll still be significant enough. Any money I can save, I'm gonna do it. Go ahead.
So what if like we don't, our house is paid for, but what if you have a house and you didn't do that? Can you start? Like say you've been living in the house for a while and you're feeling like, man, I wish I knew this. Can you start immediately? Is that something you can start?
If you're living in a house and you still have a mortgage right now,
Yeah.
You just have to go. So I guess that's the last thing I wanted to I would go to. You have to go to like you could go to a credit union. I recommend a credit union anyway. You can go to your bank if you have a bank, see what their rates are, but I recommend a credit union. And you would look, if you're going to the website first, you look for home equity. So sometimes it won't say home equity. Sometimes it will say like personal banking, and then I go to I'm looking for loans. Loans. Where is mortgage? So you'll see loans or mortgage. So you go to the mortgage section, and then not all banks, not all credit unions have home equity lines of credits, but the ones that do, you'll see something that says home equity. Sometimes they don't even advertise it. Sometimes it'll be in the regular mortgage section, and then they'll have a small section under that that says home equity. So, but on this bank, we click home equity programs, and then they give you two options: home equity loan, home equity line of credit. We are not talking about the home equity loan. We do not want that. We want the home equity line of credit. That's going to be better for what we're trying to do. That this is an entirely different product. And so from here you can apply. You can, on this website, yeah, you can apply. This you're in Tacoma. I know you don't need it right now, but anybody in Washington, this place made it very simple for me to apply. They didn't give me a bunch of questions about what am I using it for or anything. They gave me more money than most of the other places. I really like this one, even though they're not giving 100% of the equity in your home anymore, only 90%. I still would use them again just because of how good the relationship I had with them. But in any state, this is pretty much what the process is. You go to the credit union or bank, and you go to the mortgage section. And then you'll see HELOC or home equity line of credit, and then you can apply for it. Someone raise her hand. Gia.
Hi. I believe it's safe to say that every few months, or even let's say every 6 months, since you borrowed from your HELOC and paid it back, and then also your principal had gone down, that your HELOC would raise up, right? Like your credit line
Yes.
would be higher, and then you could actually borrow instead of 10,000. Let's say it raised up to where you could borrow 12,000. Now you have your bill is still pretty much the same as 5,000, but yet you could pay your mortgage extra 7,000. So then it gets faster and faster to where
Yes.
you could pay it off instead of like 10 years. That's why you could technically pay it off within, like 7 years or so.
That's very true. Very true. The first HELOC I got was $30,000, and then the equity in my home just went sky high very fast. So I asked the bank, "Can I have another HELOC?" And I said, it was so funny. I said my HELOC's 30,000. They said, "How much do you want?" I said, "Can I have 200,000?" and and they just kind of looked at me like, "That's a big jump. Why do you need that?" I said, "I just need it to do stuff." And I told them whatever reason I told them, and they gave it to me. And so having that big jump, exactly what she said. Now I can pay down a lot more quickly. Now, I want to get to this is the last thing. I'm sorry. This is the last thing I'll leave with. The 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 cons of a HELOC. There are some, it's not necessarily a con, but thing you just got to look out for. Be careful about. Oh, I didn't even put it in the slide. Most HELOCs are variable rate interest rates. I stay away from those. This is another reason why I liked this credit union, because they have fixed rate HELOCs. So, credit cards are variable. They can go up, they can go down. this is a line of credit, so it can have that same effect. So what I tend to look for is fixed rate Heloc, and if you search online, there's some websites that will come up. Like, for example, here's Navy Federal Credit Union, and you can see they have a product called fixed rate home equity loans. That's not really what we want, though. We want equity line of credit. So this is not what I would want, actually. But they're out there. You just have to look for them. But this is one of the reasons why I chose this bank. They don't even advertise it, but when I asked them, they did have the option for a fixed rate home equity line of credit. And the reason I say that is because, just like the example that was just given, once you get more and more equity in your home, you can increase it, but that becomes very, very risky to have a higher balance if you have a variable interest rate. So that's one thing I would caution you about. Try as best as possible to get a fixed rate home equity line of credit so you don't have to worry about the fluctuations. Oftentimes a fixed rate may be a 0.5% or 1% higher than the variable rate, but it's worth it. At the end of the day, the amount of interest you're paying, like what we saw earlier, it's so negligible that it's not even hardly worth mentioning when you compare how much money you're going to be saving from doing this method. Go ahead, whoever raised their hand.
Another warning that I thought of is that you really have to be a good steward and with the money that you borrowed, and be like, stay focused on your goal instead of, oh, I have this extra money, all my bills are paid, then I can go shopping. You have to be diligent with why you're doing the HELOC instead of
Yes.
get excited with extra money.
Yes, exactly. Thank you for bringing that up. That's the last thing I have on my list. If you're not disciplined, stay far away. If you know you don't have good spending habits, it's not even worth entertaining this idea. Uh, the other thing that will cause you to stay away from this is, if you don't have any money left over in turn after you pay your bills, you also don't want to do this. You need to have some money remaining after you pay your bills from your paycheck. Otherwise, you're just going to get in even more debt. So that is my presentation for today. I hope you learned something. I definitely love this strategy, and I have used it not only for paying off my home, but I've also used it for investing. I was able to build another home in addition to this, by using it, and able to sell that home to make even more money. So it's just about a matter of being wise. But appreciate all the hand claps and stuff.
You gonna share about how you did that on another video?
Yeah, not today.
Okay.
I wanted to focus on the mortgage part, because the first step is getting the home equity line of credit. That's the first step. Just get it. Then once you got it, then use it to pay off your mortgage if you got one. And then if you don't have one, then you can start using it to do some other things. Yeah. Then you don't have to go to the bank. Yes, I did.
Is it on YouTube or where?
I haven't posted it yet. I have to post it on YouTube. I'm not even going to edit it. I'm just going to post it because I'm not editing anything anymore. I don't feel like it. So I'll post it pretty quickly.
Okay.
This I was going to say one thing I forgot. Anyway, if you have any questions, let me know. There's different strategies you can use, and there's also different institutions you can go to, and if you there's several people I know that are using this already. So I'm a testimony. It works. It really works. I discovered this because I noticed I'm paying so much money towards interest in my house. Once I bought my first house, I said, there's got to be a way around this. So I look as hard as possible to find something and found this. And I used it, and it definitely works. But do your own research, please. There's all kinds of videos and articles and things that talk about how to use it. But don't expect your local bank to give you the scoop on this. But if y'all are interested, I might do another one of these, and we can go through a little bit more detail. I'll just get everyone's opinion and see if you want to learn more stuff like this. But
Yeah, I'm interested. I'm kind of interested.
okay. All right. Well, if no other questions, I'm gonna end with prayer. And toda everyone for showing up. Really appreciate it. Really appreciate it. So Abiyah, we praise you, we thank you, we give you glory and honor. Thank you that you're showing us these things. Thank you that we get to come together in your word, and now we go coming together to learn about finances and being good stewards over what you've given us. I ask that you continue to bless the remaining of our weeks, and I pray that you bless everyone's finances on this call. I pray that you give them abundantly uh, um, above even what they imagine that they can have. Father, I pray that you bless us so that we can be a blessing to others. We give you praise, we give you glory, we give you honor in Yahushua's name. Hallelujah.
Hallelujah.
Hey.
Little
All right.
toe.
Leila Tov. Shalom.
Shaichi doing this, okay?
Oh, thank you, Toda. I'm gonna I'm sorry. If anyone wants this video, I'll send a link as soon as it's done. As soon as it's done.
Yeah.
Yeah. All right.
Dude.
All right. Talk to y'all later. Leila Tov.
Right. Definitely.